Good morning, ladies and gentlemen, and welcome to Cepsa's first quarter 2021 results presentation. This is Gonzalo Sáenz, Cepsa's Head of Finance. Before we start, please take a moment to read the disclaimer on the first page of the presentation. Please note that financial information contained in this document is unaudited and certain figures are non-IFRS. This webcast, including the Q&A session, may contain forward-looking statements. These statements reflect the company's beliefs, intentions, and current expectations concerning, among other things, the company's results, operations, financial condition, liquidity, growth prospects, and strategies. Forward-looking statements are not guaranteeing of future performance of the company. You can send us your questions through Slido during the presentation. To do so, please go to slido.com and enter the passcode showed on screen. Cepsa results. You may post your questions at any time during the presentation, and we will make our best to address them at the end of the presentation. I kindly ask you to please identify yourself when posting your questions so that we may refer to you when providing answers. Today's conference call will be conducted by Salvador Bonacasa, Cepsa's CFO. So, Salvador, the floor is yours.
Thank you very much, Gonzalo. Good morning, ladies and gentlemen, and thank you for joining us today for Cepsa first quarter results presentation. This is Salvador Bonacasa, CFO of Cepsa. First and foremost, we hope that you and your families, friends and colleagues are all in good health, given the current circumstances. In today's presentation, I will be taking you through some key highlights of the first quarter, which has been still affected by the pandemic as well as adverse weather conditions in Iberia. As you may recall, in the beginning of the year, the largest snowstorm of the last century hit Spain and the vast majority of Europe, negatively impacting the mobility on the top of the existing travel restrictions due to COVID-19. However, the quarter has also shown some promising signs of recovery, such as the increase in crude oil prices, the ongoing strength of our chemical businesses, the recovery of demand during the month of March, the improvement of refining margins in the month of April, and finally, the acceleration of the vaccination campaign in Spain, which will also help to gradually recover the activity levels pre-COVID. Let's start our presentation with our first quarter 2020 highlights. We have seen a relevant increase in EBITDA of 17% versus Q4 to €324 million. This is a continuation of the improving trends in results seen in Q3 and Q4 2020. However, this represents a reduction of 28% in comparison with 2020 first quarter, reflecting the impact of the global pandemic on the energy industry. It is worth highlighting that Q1 2020 was only partially affected by COVID, as lockdown measures were put in place in Spain during the second half of March. Nevertheless, the ongoing successful execution of our optimization plan positioned the group strongly for 2021. This will enable Cepsa to capture opportunities as market continues to improve. Our first quarter reflects the still volatile environment for the global oil and gas industry. However, the combination of management actions and the strength of our diversified businesses has helped us to preserve cash flow generation and a strong balance sheet, supporting our credit rating. Upstream delivered stronger results with EBITDA of €171 million, up 41% versus Q4 2020, helped by a stronger oil price and higher production. Chemicals registered another quarter at record levels, with EBITDA of €100 million and a strong performance across all market segments. Refining was impacted by continued pressure on refining margins, partially offset by a strong trading results, and commercial suffered weaker volumes in the January and February impacted by travel restriction and abnormal adverse weather. The successful execution of Cepsa's contingency plan during 2020 delivered accumulated savings of over 500 million euros and included a reduction of 20% in the capital investment program compared to pre-COVID levels. In Q1 2021, this program of management actions limited the impact of weak European and Spanish market conditions. It also ensured Cepsa is well positioned for the future and will benefit from any improvement in market conditions in this year. Accounting CapEx in Q1 2021 was 104 million euros, a 45% decrease quarter-on-quarter basis. CapEx for the year will be closely monitored for optimizing opportunities. Finally, we would like to highlight that in March, Fitch affirmed Cepsa BBB- rating with a stable outlook, highlighting the company business diversification and management action taken to preserve cash flow generation. Moving now to slide 7, you will see the evolution of the main external variables that affect our businesses: crude oil price, refining margins, euro-dollar exchange rate, and automotive fuel demand in Spain. The Brent oil prices rebounded to an average of $61 per barrel during the first quarter, up 38% quarter-on-quarter, due to an improved macro environment driven by global COVID-19 vaccination and sustained OPEC cuts. Whilst the oil price has remained above the $60 per barrel level, the outlook for crude price is still uncertain. Refining margins during the quarter were under pressure at $2.1 per barrel versus $2.4 per barrel in Q4 2020, due to continued subdued demand. As per the euro-dollar exchange rate, during Q1, we saw the US dollar gradually depreciating versus the euro, continuing the trend initiated in second quarter last year. Lastly, with regards to the fuel demand in Spain, the first 2 months of the year were impacted by the third COVID wave and adverse weather conditions. Notwithstanding, we have seen a strong rebound in March, with an increase of 23% compared with the same period of 2020, which was already partially affected by the pandemic. However, the accumulated demand for the quarter has not yet reached the pre-COVID situation. The figures for the first 3 months of the year are 1 million cubic meters below those of 2019 and also 2018. On slide 8, we have a comparison of key operational and financial figures for the first quarter 2021 versus Q4 2020. Working interest production was 76.1 thousand barrels per day, an increase of 5% compared to the previous quarter. This was impacted by a significant increase in Abu Dhabi working interest production, increase of 14%, and on account of lower OPEC Plus production restrictions. In particular, lower quota restrictions in January and March in the Emirates have been partially overshadowed by the higher quota imposed in February. Realized crude price improved significantly from $44.1 per barrel in Q4 up to an average of $59.7 per barrel, a 35% increase due to an improved macro environment. There was a slight decrease in upstream OPEX per barrel from $9.9 to $9.1 per barrel, mainly due to changes in the geographical split of working interest production, with higher contribution of Abu Dhabi fields on the back of lower OPEC Plus quota restrictions. The utilization rate at the refineries stood at an average of 67% during Q1, and we experienced uninterrupted operation with refining still at low levels. Cepsa plans to resume production of the 2 units at its Huelva refinery during Q2 to bring refinery utilization levels back to more normalized rates around 85%. Commercial product sales stood at 3.6 million tons, in line with the last quarter, despite the impact of new travel restrictions and the impact of the Filomena snowstorm across the Iberian Peninsula in January. In chemicals, product sales, which were already strong, increased 4% from levels registered in Q4. Moving on to the next slide, we will likely to briefly comment on the performance of each of our businesses during the quarter. Upstream improved its performance on a comparable basis, up 41% versus Q4, registering a clean CCS EBITDA for the first quarter of 171 million euros. This improvement was mainly due to the increase in sale oil prices during the first quarter, with a particularly positive impact on the Abu Dhabi results, which also benefited from increased production driven by lower OPEC quota restrictions. The average realized crude oil price was 59.7 per barrel, 35% higher than Q4 2020, due to an improved macro environment. Growth capex of 28 million euros mostly involved the development of the Sarb and Lulu fields in Abu Dhabi. About refining, clean CCS EBITDA was 8 million euros, up 32 million euros compared with 2020 last quarter, due to positive trading results supported by contango inventory transactions, lower logistic costs in the refining businesses due to lower prices at freights, as well as the savings obtaining from the optimization programs launched last year. The increase in EBITDA was also partially due to a change in allocation of corporate costs to better reflect the underlying profitability of each business unit. The change in this allocation of corporate cost did not result in a material impact to any other business unit. Output of Cepsa's refinery was 4.2 million tons in this quarter, representing a 6% decrease versus the last quarter of 2020, while Cepsa refinery's utilization rate was 67%, partially due to a scheduled maintenance turnaround of certain units at our Gibraltar refinery. Additionally, the extended maintenance turnaround of 2 units at our Huelva refinery that were carried out in September continued through Q1. These units are planned to resume production in the second quarter, which will bring refinery utilization levels back to around 85%. Refining margins remain under pressure due to continued subdued demand driven by the ongoing impact of COVID-19. In the first quarter of 2021, commercial EBITDA fell by 13% quarter-on-quarter to 80 million euros. Cepsa experienced a slight decrease in volumes versus the last quarter of 2020 due to new travel restrictions put in place in early 2021 to fight against COVID-19 and the severe impact of the Filomena snowstorm across the Iberian Peninsula. The kerosene for aviation demand remains at very low levels. Margins, however, remained healthy with improved figures in wholesales and bios versus Q4 2020. All segments in chemicals performed very well, resulting in a clean CCS EBITDA of 100 million euros in this quarter, in line with the record results achieved in the last quarter of 2020, and with robust margins experienced in all segments. In particular, results were boosted by high margins in the phenol and acetone segment due to supply shortage in the market, as well as the continuing strong performance of the LAB segments. Sales of chemical products increased by 4% to 715 kilotons. Sales in the LAB business segment, raw material for detergent, as you know, were down 6% versus Q4, associated with a 45 days long turnaround at Puente Mayorga plant, which began at the end of January. In the phenol and acetone segment, sales increased by 11% as a global demand improved for plastics and fibers, and the supply shortage above mentioned. Sales in the solvent segments were in line quarter-on-quarter. Market condition remains supportive for Cepsa Global's leadership position in these areas. Moving on to financial metrics, improved performance was underpinned by the rebound in crude oil price, and stronger results continued the improving trend since in 2020 last quarter. A strong recovery in crude oil prices registered during the quarter and continued optimization initiatives has allowed Cepsa to post a solid clean CCS EBITDA of 324 million euros in this quarter, 17% above that registered in the last quarter of 2020. Upstream had a significant improvement in results compared to Q4 of 2020, with clean CCS EBITDA up 41%, boosted by higher realized price in the quarter, which were up 35% versus Q4 2020. Refining was able to provide a better contribution to EBITDA quarter-on-quarter, despite refining margins remaining low this quarter. Chemicals continued to outperform in Q1, with clean CCS EBITDA at similar levels of those registered in Q4 2020, and robust margins in all segments. However, commercial is still being impacted by travel restrictions associated with the pandemic, and therefore its contribution to the quarter was minus 13% lower than in Q4 2020. With regards to the other key financial metrics, clean CCS net income for the quarter was 53 million euros, coming from losses in Q4 2020, positively impacted by the strong EBITDA performance and lower depreciation cost. As you can see in the slide, IFRS net income, 75 million euros, and cash flow from operation before working capital movements, 309 million euros, also show a very positive performance compared with those registered in Q4 2020. Moving on to slide 14 on cash flow generation. Okay, thank you. Cash flow from operation before working capital stood at 309 million euros, an increase of 42% compared with Q4 2020. And the improvement was driven by higher CCS EBITDA and lower income taxes paid as a result of a tax return being cashed in during the month of January. Working capital variation during the quarter was negative 230 million euros, resulting from higher inventories, mainly due to an increase in volume and prices, and an operational working capital build-up in response to the rise in crude prices. CapEx payments were in line with those of Q4, highlighting payments associated with E&P assets development. Free cash flow was negative by 95 million euros in the quarter as a consequence of the negative impact of working capital realization that offset the higher EBITDA contribution in the quarter. However, we expect that the negative working capital variation registered in the quarter will be absorbed in a very short term. Let's now move on to slide 15 to discuss our capital structure. Regarding balance sheet and liquidity of the company, there was a slight increase in overall debt levels in the quarter, mainly due to working capital consumption that we mentioned before, with net debt standing at 3 billion euros as of March 2021. The leverage ratio, based on last 12 months EBITDA, deteriorated due to the full impact of COVID-19 results. Consequently, in Q1 2021, the net debt to EBITDA ratio peaked at 3.3 times. We firmly believe that this is the peak of this ratio, as EBITDA reflects the full impact of 12 months of pandemic, and that throughout the year we will be approaching to normalized levels. Average debt maturity at the end of March stood at 4 years. And it is worth highlighting that Cepsa continues to hold a very strong liquidity position comprised of cash on balance sheet and available committed credit facility of 4.5 billion euros, which is enough to cover 4.5 years of debt maturities. Now, taking a closer look at our debt maturity profile, I would like to flag the following. Cepsa has been working since the inception of the pandemic to reinforce its liquidity and extend its maturities. As can be seen, there are no significant debt maturities until 2024, and on the other hand, most of the available committed lines mature in 2025. Therefore, there is not any significant refinancing risk up to that year. Lastly, as previously stated, total liquidity understood as cash plus available committed facility stood at 4.5 billion euros by the end of the quarter. Now, we would like to review the short-term market outlook. Firstly, it is worthwhile highlighting that we expect gradual recovery linked to overall macro environment. Going into details on each individual business, in upstream, we expect oil price to remain stable in the $60 or $60+ per barrel range. Production is expected to grow in sync with the lifting of OPEC quotas and the oil demand recovery in the second half of the year. In refining, margins are expected to remain under pressure in the near term, although we have seen some temporary signs of recovery during the month of April. Run rates are expected to increase in Q2 according to expected recovery of demand, as we mentioned before. In commercial, as volumes are more directly linked to travel restrictions, we expect these to gradually recover as restrictions are lifted and the summer season commences. Margins are expected to remain healthy in line with previous months. Finally, in chemicals, we foresee a strong performance to continue in all business segments, with volumes remaining stable and no material change in margins in the near term. In March, Fitch confirmed Cepsa's BBB- rating with a stable outlook, highlighting the company's business diversification as well as management actions to preserve cash flow generation and the shareholders' commitment to Cepsa investment grade rating, as evidenced by the significant reduction in dividend payments. At this point, I would like to emphasize that maintaining investment grade ratings is a key priority for both Cepsa and its shareholders, and in that respect, the company will continue to observe conservative financial policies. And with this slide, we conclude today's presentation, but before moving to Q&A section, I would like to say that we are cautiously optimistic about the future, with probably the worst part of the COVID-19 pandemic behind us, as the vaccination campaign advanced at a relatively good rhythm, and almost 10% of the Spanish population is already immunized. I am pleased that the successful execution of our optimization plan has enabled us to continue our trend to increase profitability and ensures that we are in a strong position to take advantage of unexpected economic recovery during this 2021 year. A combination of management actions and the diversified strength of our businesses has helped to preserve cash flow generation and a strong balance sheet, supporting our credit rating. I am really excited by the significant opportunities that energy transition represents for Cepsa. I look forward to setting out our strategic plan in the following months, as previously stated. For this presentation and further details on Cepsa results, I encourage you to refer to the press release and quarterly report which will be published on Cepsa website right after this call. Thank you very much for your attention. Gonzalo?
Thank you very much, Salvador. We will now move to the Q&A session. Please let me remind you that, once again, how you may direct us your questions. You may go to slido.com and enter the passcode showed on screen, Cepsa results. Once on the event page, you may type your questions in the dialog box. I kindly ask you to please identify yourself so that we may refer to you when providing answers. Many thanks. Okay, looks like we don't have any questions at this point. So in any case, please let me remind you that you may get in touch with us at our investor relations email address, which is investorrelations@cepsa.com, and you may direct us any questions you may have at any time at that email address. So thank you very much, everyone, for attending today's presentation. And this is it. Thank you very much. Goodbye.